Jay says, you had mentioned the cost of options, but the implied volatility on SPY and QQQ still seems really low. Can you elaborate on that? Okay. Let's go to SPY. What we're looking at here is the stock research tool. So anytime I can put in a symbol here directly on Power Options, I can look directly at the option chain. Spread chain we might talk about in a little bit, or I can go to quotes, which links me here to the research page. So let me just look at SPY. The 20-day excuse me, folks. The 20-day volatility is at 0.51 for SPY, Standard & Poor's ETF. Similar, the numbers for SPX would be similar. The Standard & Poor's Index, the SPX, excuse me. 50-day volatility is at 0.34. 100-day volatility is at 0.26. 250 days at 0.19. Normal standard market conditions, we think about the melt-up market. You hear me refer to these different market conditions, but the melt-up market of 2021 after the pandemic, it was essentially lower left to upper right. It wasn't a lot of volatility, and we had some dips. But what we were looking at is that you were gaining about 2%, maybe 1% on SPY or QQQ every month, and then you had a little 0.5, 0.7% drop. Moved up another 2% in the next 30 days, and then had a 0.6% drop. This was a melt-up market. At this time in 2021, the 50-day and 20-day volatility of SPY were in the norms of what you'd normally think in a standard market condition. We're at 0.14, 0.12. The VIX is down to 12, okay, 11. It's in those ranges. Everything is just gradual, calm, and moving up. Strategies I just mentioned as a market hedge, buying calls on the VIX, doing straddles or strangles on SPY, even though the market was moving up, it wasn't fluctuating. It wasn't volatile. These structures did not work in the melt-up market. Now, of course, 2020, you can imagine. 2022, I'm starting to refer to just as the Powell market. I should refer to it as the inflation market, but I refer to it as the Powell market. We talked about just a few moments ago. Those ideas, again, of the long strangles on SPY and QQQ, 40 to 55 days out in time. Then as it dropped, you just took your profit and moved it back down to that new level. And then as it moved back up, you just move the strangle back up again out another 45 days or so. Not using your whole portfolio to do this, but using it as a market hedge in the volatility and using it as a way to take some extra profit. Hedge some losses that you might be taking on other positions, as when Powell spoke, the market tanked, and then the next day he said he did what he said he was going to do, what the Fed was going to do, and it came back about 40, 50, 60% of what it lost just 6 hours ago. That was the Powell market. 2023 was a little bit of a mixed bag. We know what 2024 was. 2024 was the market of the Mag 7. Let's just be honest with that. Everyone was in hype. AI, the Magnificent 7 stocks, that's what everyone was looking at. That's where everyone's focus was. A lot of money was made. And then here we are in 2025. We had a good run in the first couple of months. Then we had that volatility that we warned about in December. So this, Jay, is what I'm saying about prices are elevated due to volatility. What does that relate to options and how we trade, what we like to do? Well, right now, there's a term that we use consistently, the term that you see, a filter that you can use on most of our 23 supported strategies is the implied volatility range. Where is the options implied volatility right now compared to where it has been over the life of the option? Now, we're not going to use the 0 day out. I want to go 28 days out. Let's go about a month out to SPY options, to the May 9th expiration series. And this isn't bad. I'm seeing volatilities at 0.3412, 0.338 at the at-the-money strikes for this, for SPY. Okay, the 534, 533 are coming back up. Volatility is in 0.3 range. But again, on average, normal market conditions, the implied volatility of SPY options are probably around 0.12. So I've seen them as low as 0.05 in my time, 0.08, 0.09. We've seen those ranges. We're triple that, more than double of what we'd normally expect. But that term that you can use as a search function, that you can screen against in the searches. Let's go ahead and change the columns a little bit. I have the IV over HV. I'm going to add that in. I'm going to add the implied volatility range and the percent implied volatility range J to my option chain. Now I'm going to change the column order because I want to see all these together. So we're going to move the IV over HV right next to that implied volatility that we just saw. There it is, implied volatility. I want the actual, this is implied volatility range, the actual numerical range of these May options since they've been released on the market. And then, of course, I want the percent implied volatility range as well. All right, there we go. So I'm going to have those set. I'm going to submit and save the column order. I'm going to be asked to refresh the window so that we can resend the data and see our columns against each other. Now, this is the small chain. I might want to use a different stock, but just for example, I know we're working on the column headings here, but let's just keep this. I'm in this row. Let's take the at the money 534 strike. It's currently at 0.3388. The implied volatility, IV over HV, is 1.0. What does that mean? It means that the 50-day historical volatility of SPY is about equal, level of 1.33, 0.34, to the current implied volatility is May options 28 days out in time. The range, the implied volatility range of this particular SPY option, the May 9th, 28 days out in time, is from 0.23, which is still double of what I'd normally expect, to 0.37, and we're at 73% of the implied volatility range. I assume this is about the average across all options, that we're currently at 73% of the total implied volatility range. Is this a buy or a sell? That's not what this is telling you. What it's telling you, Jay, is if you want to buy this option, understand that you're paying into a higher price, an inflated price, due to the fear gauge of the market, the fear gauge on this particular ETF. You would say, okay, well, if the stock moves up 5 points, I would expect to make $500 or $600 on this option if I just bought one contract, maybe $700. But if the implied volatility drops from 0.3388 back down to its norm of 0.2358 or less, you're not going to make that much money. The extrinsic value, this is inflating the extrinsic value of the option. This 534 we're talking about is all time value on this particular call. If the implied volatility decreases, even if the stock moves up, your return is going to be less, because that's going to suck away that extrinsic value or that time value that we're looking at. Now, we're talking about the 20. Before I do that, we're going to come back to this 534 strike for May 9th, 238, and show how that implied volatility affects your potential return on the position. But I'm going to go out further in time. I'm going to go out to January 16, 280 days away. Look at our 535 strike. Farther out in time, the nearer term option, that 28-day out option, that we were looking at, is currently at 0.2461. Is that telling you something? In a sense, it is. What it's telling you is that right now, over the next 28, 30, 40 days, the options at near the same strike that we're looking at the 535 compared to the 534 for May 9th expiration. But that was at about 0.335. And, the total range was at 0.35. Again, triple of what we'd expect to see. Look at this. These options, these year-out options still, 260-day out options on SPY, which have been in the market for probably close to a year and a half to maybe even 2 years. Their lower range is exactly where I said it was, 0.12, 0.13. Still 260 days to go, and the implied volatility is at 0.2461. Is that telling us something? Well, the subtle thing it's telling us is that right now, the implied volatility over the next 30, 40, or 50 days, we could look at other expirations, is saying that the expectation of the market is still pretty wild, meaning that the May expiration, we saw the May 9th expiration at 0.35 implied volatility, the market is still expecting fluctuations. It's still expecting risk over that time frame. But 160 days out, 180 days out, it's expected to mellow. Things are going to calm down, hopefully. That can change on a dime. We all know that. But that's what it's kind of showing us. But an option that has been available for 2 years, same security. The range of implied volatility is only 0.1336, 0.1240. This is the range we expect for SPY. What we're seeing right now, 28 days out on time, is what? Almost triple that. 0.338. Okay, double that at the low, since this option has been released, triple that at the high, and we're still close to triple it where we are right now, just 28 days out in time. And closer in, let's just go 10 days out, April 21st. Wow. We're at the point, I mean, some of those in the money ones are 0.4, but still, here we are triple of what we'd expect. We expect an implied volatility on SPY options at 0.12, 0.33, 0.13, excuse me. Here we are at 0.3669. 0.4416. That's something you commonly expect to see on a NVIDIA chain. Even in a good bullish run, but on a Tesla chain, right? You don't expect to see this on SPY. You don't see this on QQQ options. Well, sometimes you do, but we do now. But these are numbers we don't expect to see for the implied volatility. It's telling us there's still market fear gauge in the short term, 10, 15, 21, 28 days out in time, which again reinforces what I was saying about we're seeing the bullish buys. Like the idea of bullish strategies right now, but I'm going to be a little bit more cautious. My bull put credit spreads, I might look for an 87 or 90% probability for my preferred search, the weekly bull puts, instead of the default 85. Bear put debit spreads, hey, still might open some of those. Still a lot of bearish affected stocks out there. I still might want to take a chance on those. But selling into the premium with the implied volatility is high is good. But directional, you want to be safe. Again, I'm not saying that we should be selling short straddles or short strangles to take advantage of the implied volatility, because there's still too much volatility. A flux could happen. We could see this go up to 56. We could see this drop down to 15 or 20. How would that happen? The reciprocal tariffs we're still talking about, and we've seen all this week, could still happen. China ups it to 150 over the weekend. You know that the administration is going to say, okay, 200 to you. You know, they're going to keep playing this game until they get on the phone and discuss it. Or the opposite could happen, and we could say pause on all tariffs again, which the administration did. But they could say pause on all tariffs, including China, for the next 80 days. And the market would go up and the VIX would calm down. Okay? And then other things could happen over the weekend too. We don't know. All right? We could see some potential, knock on wood, potential settling of the global conflicts in Eastern Europe, Ukraine and Russia, or in Middle East, Israel and Palestine, Israel, Gaza, or, you know, Iran says, no, we're going to talk to the US, and we're not going to try to push our nuclear agenda too soon right now. We're going to just take a step back and see what's going on. All of that would lead to a bullish run, the VIX falling, or all three of those could go the opposite direction. Okay. A little bit more conservative, a little bit more safe, but we're seeing the directions we want. We're seeing the will for the market to go the directions that we want. So those are just some of my thoughts. I was actually, this is funny. You know, we were talking about this. We talked about this for Jay. There was something else I'm sorry I had to go back to. We have to go back to that. Let's go to the custom spread tool real quick. We were talking about that May 9th 28 days to expiration, 540 odd strike. 544 was it with these, or was it the 534? I apologize, ladies and gentlemen, at 2046. All right. So let me just add that in there. So I'm speculative. I'm bullish. I'm going to buy an at-the-money option. It's expensive because of the implied volatility that we talked about, that it's near the top 73% of its implied volatility range since this option has been released on the market. Let's put that midpoint at 2046. Let's keep it even. Okay. Fantastic. Now, of course, my upside is unlimited if the stock moves up. Sorry, stock. ETFs moves up. Let's say in 30 days, I think we're going to get back. I think we're going to get back to about 566, 567. I'll stay with 566, okay? I think we're seeing a 20 to 30 point gain in the next 28 days. Things are going to settle down. Things are going to move in our favor. The tariff war is going to settle down a little bit. Some of the conflicts in Eastern Europe, in the Middle East, and so forth are going to settle down. Things are looking more rosy. We're going to get this settled. Now, remember, our implied volatility is at 0.338 right now. The low for this option, since it's been released on the market, I think we saw was at let's just take a look. I think it was 0.24, 0.25. Let's go back to that research and the option research tool to show me the implied volatility range. Because I think I closed the chain. That's okay. Let's just do it here. So this is the history of the option. This is what you can see on our research page. And this option has only been available since April 4th when volatility was going. But over here on this page, there we are at 0.338. It was 0.2358. Let me jot that down. 0.2358. And the high, of course, was 0.3769. We're a little bit off of that, but not too far. And the Black-Scholes value for this is 2188, and I think we saw we're paying a little bit more for that on that custom spread tool. It was 2046, so a little bit less. Good. Now, halfway between now and our expiration date of May 9th, April 28th, 2025, 17 days away, SPY hits my expected target. I said 566. Okay, paid 2046 for the position. This calculate tool is showing me, based on the Black-Scholes pricing model, this will be worth 35.28. So we made a profit of 1,482 off of an investment of 2046. We're looking at a good, strong profit on that particular position, right? That's fantastic. That's pure profit, by the way. That's not just the option's worth 1482. We made 1482 off of our investment of 2046. We're 73% return. But if SPY is moving up in the next 10, 12, 15, 17 days, the fear gauge is going to drop. The implied volatility is going to drop. Let's say it drops back to its low of 2358 from when it was released on the market. How's that going to affect our position? All right, not terrible. We're in the money. 17 days to go. Our 534 strike, still a reasonable price, but we gave up about $200 or so. Okay, from 1482 profit down to 1292. Now, a lot of things get settled. Tariff discussion, everything along those lines. Some other things happen. The market calms down and SPY goes back to its SPY options as a whole. All expirations from 10 days out to 5 days out to 260 days out goes back to its norm around 0.12 or 0.13. How does that affect the position? Okay, not too much. We lost about $10. Where are we now? We're pretty much straight intrinsic value, aren't we? Stock's at 566 expected price, still 17 days to expiration. We have the 534 May call. We're 32 points in the money, and we're at 32.65. We're straight at intrinsic value. But that was a significant difference, wasn't it? Again, we're at 0.338 right now. 0.3338. That was that 1471, 1482 profit. I think it was a little higher. Maybe it was 0.3388. Sorry about that. But going back to its low for this particular option at that 0.2358, without the extra decimal point, Mike, because the system won't read that correctly, you're giving up that profit. Okay. And if we entered in at the high, remember 0.385, shoot, sorry folks, I forgot the number, 0.3769. Okay, 0.3769. If I entered in at the high at 0.3769, $1,500 profit, still pretty good. I mean, and that is good, don't get me wrong. But if the implied volatility fluxes back to 0.12, we're down back to that 1,200. Gave up $300 of profit. That's the effect that you'd expect to see in implied volatility. Am I saying that you shouldn't be buying calls now if you think things have settled, you're trying to pick the market bottom, you think this was an overreaction? No, I'm not saying that. What I'm saying is that if you're analyzing buying options, whether it's on NVIDIA, AMD, the Mag 7, you're thinking things are going to return, you're thinking we've hit the bottom and we're going to settle out, this tariff thing's going to work itself out, there's going to be some flux, but if I go 40, 50, 60 days out in time with an at or out of the money debit spread, bull call debit spread, for example, with buying calls in this situation, now that we're seeing the bullish buys come back, thinking that things are going to get settled down, you have to take into account the change in implied volatility for calculating your return. Okay? It's just like we've had conversations in the past about buying calls, buying puts around earnings. Hey, I think the stock's going to go down. I'm going to buy a put on this stock. And it did go down. It went down 12% as I expected, but I only made $200. I thought I was going to make $1,200. Implied volatility crush. That's what it's called. How does Power Options help you with that? Again, when you're looking at the option detail or setting it, you can set it on the option chain. As we saw, you can use it in the search criteria for most strategies, implied volatility range. Right now, we know that all options across the market are on the higher end of their implied volatility range just due to what's been happening in the last 5 or 6 days. But normally when I'm buying calls, I put in a filter, or puts, I put in a filter for a percent implied volatility range of less than 50. So I don't want to be overpaying for the option. I might even use the IV over HV or the Black-Scholes ratio to be less than 1. IV over HV, the current implied volatility of the option compared to the historical 50-day volatility of the stock. I might want that to be less than 1 because I don't want to be overpaying into the position. And the IV over SIV makes sense. SIV, by the way, is the average implied volatility of the in-the-money and out-of-the-money calls and puts for the next few expiration cycles. So, of course, I expect this is okay to me to be less than 1. That's where I want it. And the reason why is because a lot of those nearer term options, 1 week out, 1 day out, 2 days out, 3 days out, we're talking SPY here, are probably still extraordinarily high. As we saw, remember when we flipped back to that near April series and we saw implied volatilities of 0.44, 0.42, 0.43. So this one's a little bit below the average, the SIV for this particular ETF. So that's good. Not a recommendation or suggestion to buy. Just saying that if you are buying options right now, calls or puts, add the columns to your option chain on Power Options. Check the research tool. Check your percent implied volatility range, but most importantly in this case, the actual implied volatility range. Then, when you go to run your what-if scenarios, what if the stock moves up to 566, 580? What if it drops back down to 544? What if it drops down to 530? What would my loss be? Include the fluctuations in the implied volatility so you can see the difference. We may experience implied volatility crush. We want to be aware of that when we're trying to calculate our potential returns and our trading plan in the market as well. Not just for our common strategies, but any new strategies we're trying to play in these sort of up and down markets, volatile markets as well.